My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Mike Mish Shedlock. Mike, a lot of people have seen you do the media rounds, I'm sure, over the last couple of years. But introduce yourself a little bit here to the audience. Who are you? How'd you get involved, interested in markets, and why Mish?
Mish is simply the first two characters of my first and last name, Mike Shedlock. So M-I and S-H. I got that from actually dates all the way back to 2003. I was hanging around chat message boards with a guy named Calculated Risk, real name Bill McBride. Many of you probably know him. And actually, Bill McBride created my first blog back then. At the time, I was out of work, had no money, no income. My background before that was a civil engineer, but I worked for almost 20 years in the financial service industry as a computer programmer. And anyway, after 911, I lost my job. Was hanging around in stock message boards, calculated risk. Bill McBride comes in and said, "Hey, look at this! I just started my blog. If anyone needs help, I'll create their blog or help you start your own blog." And so Calculated Risk created the first template for my blog back in 2003. And by 2008, Calculated Risk, myself, and a guy named Barry Ritholtz were the number one, number two, number three independent financial bloggers in the country. And I've been doing this ever since 2003.
I'm a big fan of Bill McBride. I had him on a space, I don't know, probably back in like July of last year. Um, it's interesting that you've been at this for a while. I used to contribute to the big picture
Yep.
from Ritholtz back in the day, right? And back then, I mean, blogs were a thing, but it was straight. It was almost like a nascent type of subcategory of the blogosphere to be talking about investing and finance. I'm just curious, given how long you've been doing the content side, the writing side, do you find it as interesting and intriguing to do it for others as you did back then, or is it more just you're kind of used to it, so keep writing?
I enjoy it actually. There are a couple of things I enjoy. I'm a very skilled photographer as well, and I spend a lot of time at photography and a lot of time at this. I People ask me when I'm going to retire, and I say, "What do I want to retire for? I'm having too much fun doing this." So I guess that's the answer, to your question there. I've had 80 magazine covers as a photographer on a part-time basis. I've just got my website up right now, offering stuff for sale. But I've also got a column where I tell people where I went, what I did right, what I did wrong, that kind of stuff, tips on photography. And so my financial website is mishtalk.com. And my photography website, if anyone is interested, is Mish Moments, Moments.com. So if you're at all interested in photography, please check that out. And at the top, you can find a section that says Mish's articles, where I write about where I'm going, what I did, when to be there, that kind of stuff. Lots of fun.
By the way, I love that you have that part of your life. I mean, for me, it's music. I like to write songs. I think it's important for those that are dealing with the business of managing money and dealing with an uncertain domain like ours from a stock market perspective that you have an outlet, right? Just to get your mind off things.
Oh, that's by the way, that's the reason I was supposed to be on a few days ago with you, and the conditions were like perfect for photography. So I'll just let you know what happened. I said I can't make it. It was because I needed to be somewhere for photography. And by the way, I got a fantastic shot. So apologies offered, but that's really what happened. But we're here now.
So I'm gonna those that probably heard you just say what you said probably cued on the word conditions because I'm obsessed with that term on financial Twitter, on FinTwit. I always get back to everything in life is about conditions. Everything when it comes to investing is about conditions. Let's lay out for the audience your view of the conditions. Where are we in this cycle? There's obviously been quite a bit of excitement the way things have played out so far this year. It's funny how price changes narrative very quickly. Lay out where we are from an economic standpoint and then from an investing standpoint, because let's face it, the two can be very different.
Oh, absolutely, the two can be different. I think we're in recession now. I'm not the only one. I had private conversations, which I've actually shared from Lacey Hunt at Hoisington Management. The two of us think we're in recession. There's a few other people on FinTwit that think we're in recession, and there's a lot of big names out there that think we're not in recession. And generally, they think we're not in recession just because jobs are strong. My gosh, industrial production was negative for 2 months, and I've been waiting for this report that just came out today. Many of you might have seen it, where even though GDP for the fourth quarter came out, I actually wanted to see what spending did in December. And real spending, inflation adjusted spending, was down for the second month in a row. So we have industrial production down for the second month in a row. Housing has literally been falling every month since January. So 11 straight months, housing has been down. The None of these are conditions that you see except in recessions, the or very frequently outside of recessions, and all of these are happening right now at the same time. We've also got the inverted, the yield curve is as inverted as most as it's ever been, dating all the way back to 1982. You have to go back to find steeper inversions than this. Money supply is sinking for like the first time ever. And I've talked about that in my blog. So the one thing that's holding up, if you believe it, and I don't actually, is the strength in jobs. But the strength in jobs is not supported by shrinking hours. The index of aggregate hours is falling. The divergence between employment and jobs is absolutely stunning. We've lost, I don't have the exact numbers in front of me, so I'm going to make an approximation. The Since May, I think we've lost 440,000 is the number that rings in my head, full-time jobs. So, what does that say? It says, people are working, maybe if the jobs number is real, and I sort of doubt it, but it's possible that it is. What it is people working an extra second part-time job, probably in the leisure and hospitality sector. That would include restaurants. So maybe they're working an extra night a week. So now you see, jobs going up because of these extra part-time jobs. Other than jobs, almost everything I'm looking at um, uh, suggests that we're either in recession or very close to recession. And it's funny, I've noticed several tweets today where some people that are fairly highly respected saying, there's no chance we're in recession now. I don't know. I just disagree.
Well, clearly, I mean, it looks different than other recessions. If we're in a recession, I don't have a personal opinion on it right now, at least. But to your point, there is a disconnect. I mean, when was the last time you had a recession where jobs were, this quote unquote strong? I'm with you on the kind of part time work and second and third jobs, but it does make the analysis arguably unusual. Is there any other time in history that you studied that comes somewhere close to what we may be in now, or is this really the cliche of it's uncharted territory?
Well, let's look at it. The straight up answer is no. We've not seen this before, really. This kind of divergences last this long. Yet, if you think about this being the opposite of the COVID recession, you should be able to make some sense out of it. We lost jobs at at a staggering rate in just 2 short months. In the COVID recession, and so now what I think we're seeing is the reverse of that. Let me see if I can find these numbers here. Um, Within 1 month of the COVID, yeah, initial claims were 4,600,000, and continued claims were 17 million. So, people saying, well, jobs are strong. Well, it's because we never gained back all of the jobs that we lost on an adjusted basis. And part of the reason for that has to do with boomer retirement. People are retiring and retiring and retiring every month. More people are retiring. Yet, the last time I looked, there were still 22 million people, 22 million people age 62 and older that were still working. And a lot of them, are going to be retiring and are retiring now. So when they retire, the unemployment rate doesn't go up, but one less person is working, right? So a lot of the strength in jobs, I think, are related to refilling. So in other words, the opposite of the COVID recession, plus we've got a boomer demographic on top of it. So that's kind of what's different this time. But of course, the COVID recession was different in and of itself. So what we're seeing sort of is the mirror image of that COVID recession. That's how I put these things together. And unlike others, and there are a lot of people that think this recession that we're either in or going to be in is going to be very strong once the Fed finally puts a pin. I think you already have, actually. They just don't know it, into pricks the this bubble that we've been in the stock market. The but all this stuff lags. So the uh, so it's just going to take a while. And you asked about the disconnect between what I think is a recession and what the stock market is doing. Uh, and people have said, well, I had a friend email me yesterday, Mesh, the stock market doesn't seem to think, we're in a recession. The stock market is a coincident indicator of demand for stock, no more, no less. The If you pull up stock markets, people say the stock market is a leading indicator. A leading indicator of what? It hit an all-time high, or back then, in 2008, November of 2008, the S&P hit an all-time high. And so if it was forward looking, what exactly was it forward looking to, given that recession started a month later? So trying to make sense out of the stock market, which rises and falls on literally the demand for stocks, which is not necessarily what the economy is doing. So you just can't look at the two and say, expect it. And believe me, I've made a whole bunch of mistakes, as probably has everyone else, thinking that these two are related.
Yeah, no, and I'll add to that point. Historically, when you look at where the S&P, for example, is in relationship to its moving average
Mm-hmm.
in a recession, usually when you're below a two-day moving average, you're already in a recession. The
Mm-hmm.
BLS will say it after the fact.
Oh yeah.
So whether you want to call it leading or not, and it's interesting to hear that sentiment. I've had others say the same thing. Last year on a real return basis was like the seventh worst year for the S&P in history,
Mm-hmm.
going back to the 1920s and 30s. So, on the one hand, you can argue that the stock market doesn't really see it, but on the other hand, it's like, okay, after inflation in real terms, it's already been pretty devastating. Uh, do you get a sense that if we're in a recession, that this becomes a short recession? So because I want to
Oh
hit
no,
on
yeah,
that.
that's a good question. In fact, I meant to.
Yeah, and because I want to go to that point, that which is, and where I'm going with that is that word you used, that there's lags. This is why I myself believe there's a credit event coming at some
Oh yeah.
point, possibly this year.
The one thing I think Powell does have right in all of this is, I mean, he's talking about a softish landing. Well, soft in what sense? I agree that it's going to be soft in the employment sense, just because of what I've said. I also think that they are genuinely fearful of inflation, and I think they should be genuinely fearful of inflation. So, what does that mean? That means they're going to keep rates higher for longer. I really think they're going to do that unless they have a credit event, which you just mentioned. Now, that's certainly possible, and it doesn't have to start in the United States. In fact, I think it probably won't start here. It's more likely to start in the EU or Japan or China or somewhere else outside of the United States. But what does that mean? So if we're not going to have strong losses from an unemployment perspective, and if that's one of the things that the Fed is really focused on, and they seem to be. They seem to be on this. We're not in recession because jobs are strong meme like everybody else or most everybody else. So that's going to keep them. And fear of inflation is going to keep them rates higher, for longer. So what does that do to the economy? It's going to make a strong recovery from whenever the recession ends. And I wrote a post back in August. I said, no matter what you call it, expect a long period of weak growth. And like 2 weeks after I said that, Powell came out and used almost exactly the same language. It.
That's because he loves photography and saw the
I
film.
don't think he's reading me at all. I would love to have a conversation with the man actually, but no, it's so whether we're in recession or not. I actually wrote a post. I said it doesn't even matter, and it probably doesn't. But what it means then, though, if there's not going to be any more QE, the Fed's not, when it does get around to cutting, it's not going to cut interest rates back to 2%. So what does that do for earnings? The earnings are, the stock market the last, what, 2 months, 3 months maybe, is on this tear, as if the Fed's going to cut this year, and I think maybe they do, because I think they're going to over tighten, but they'll get in one cut and then they'll step back for a few months and then maybe get in another cut. So is after the Fed hikes twice more and then cuts twice more. Okay, you know, mortgage rates are still likely to be above 6%. Right. Housing is, hasn't significantly fallen in price, and maybe doesn't or takes a really long time. So we're not going to have a strong housing rebound. And interest rates are higher. So all the corporations rolling over their interest debt are going to have to pay more than they have been for the last couple of years. The whole global economy is sort of in the same boat. So, what does that do for earnings? So, from a stock market perspective and an economic perspective, I think the two are going to catch up and sort of merge and go along the same line, where we're floating in and out of recession or close to it, or very, very weak recovery. Say 1% or 0 to 1% for 8 quarters, 2 years. The stock market, as I see it, is still priced for perfection, and maybe we don't go in and out of recession. But I think Powell did get one thing right: is we're not going back to a lot of QE, and stocks are overpriced.
Yeah, and I keep going back to I keep using that line on and on, that the death of QE, death of zero interest rate policy probably levels the playing field from a global equity
Mhm.
perspective, because is that you never really had the fat left tail, which historically you would have. It suppressed the volatility on the loss side for
Yeah.
U.S. equities, for the S&P, and now you level the playing field by not having that. It is intriguing, right? Because I've been seeing this kind of melt up conditions argument for about 3 weeks, and I'm loud on Twitter about it. But it's a very reflationary move. I don't think you can debate that. Just the way the year started, you got lumber, you got commodities, you got a lot of things that are basically screaming reflation, which is
Hmm.
curious because it's screaming reflation as inflation may have peaked, which means the Fed may have to, step in at some point to try to counter the enthusiasm because the market then becomes inflationary, countering the Fed, right? Just as we peaked on inflation. So that's why I think this is a really interesting sequence that could be happening here. You get this optimism, but then at some point it has to be countered by reality.
Exactly, and we might see a little bit of counter to the reality. When does the Fed meet? I think it's February 1st. Is that right? The anyway, it's coming up in just a matter of days. Now, it's pretty much a given that the Fed's going to hike a quarter point. A lot of people are out there; they're looking at the strength in GDP and whatever, and saying, "Well, my gosh, Fed needs to hike a half a point." My gosh, if you actually look at the internals of that GDP report, it kind of stunk. But what the Fed is going to do, I think, is is try and strengthen its message that hey guys, we really aren't interested in cutting, and we are going to hold rates higher for longer. The market keeps bucking up, with the Fed on that. It's possible if inflation, kicks up again, that there are no cuts, this year. And again, one thing that can keep, the Fed on this track is jobs. And I just it's and there's two different numbers here. I think we're going to see a substantial fall in employment, and that's going to be based off of people retiring, buyout packages, all kinds of other stuff, from firms. But the unemployment number, none of that adds to unemployment. You have to be out of work and looking for work and want to work to be unemployed. So the from that unemployment number perspective, I'm just not seeing this huge jump in unemployment that everyone thinks, and that can keep the Fed. If unless there's a credit event, you know, there won't be a lot of political pressure on the Fed unless unemployment rate jumps. So Powell does have that going for him.
But by the way, I will say it's like I know a lot of people, they think that sure the Fed's going to step right in and do QE again. It's like, well, you do QE after everything we just went through with inflation. The optics of that are going to be horrible, right? It's going to be hard for them to even justify, at least for a moment in time. And the truth is, the bond market, the sell-off has been really deceptive, right? Because as you keep alluding to, and I keep alluding to, it wasn't credit spread widening; it was duration. Spread stayed tight throughout that. Even today, they're still very
Yeah.
tight. That's another thing which is what you can argue inconsistent with the recession narrative, which is why this is so unusual. Usually, if you're in a recession, default risk premiums rise. You haven't had
I,
that despite right the fastest rate hike cycle in history, but that again could be because there are lags.
Yeah, let's look at the. I've got the numbers up here. I just pulled up my article. Let's look at fourth quarter GDP. Now, real GDP was up 2.9 percentage points. Actually, that beat the street by zero point 0.2 percentage points. I think GDP now had it 3.5%, if I recall correctly. But real final sales, they were only up 1.4 percentage points. Now, that's the real bottom line number of the economy. So back in first and second quarter, we had negative GDP back to back, and people were saying recession, recession. Actually, I said no recession. The because real final sales were positive, and it's hard to have a recession when real final sales are positive. Now here they're positive, but but if you look at it, real final sales to private domestic purchase was just 0.22%. Now, how much of that was there was a real spending surge in October. So we might have had real final sales to private domestic purchases actually negative in either November or December. So what we had is government spending, military aid, all this other stuff added, 1.2 percentage points to real final sales. When the NBER looks at this, I think they're going to be looking at real final sales to domestic, or excluding some of this government spending money to Ukraine, whatever. I don't really know the whole makeup of this, but this was in many ways much weaker report than what it looked like on the surface. And of that 2.9 percentage points of GDP, since 1.4 percentage points was real final sales, guess what? That means 1.5 percentage points was inventory add. Ding, 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 ding. Adding inventories heading into one of the biggest drops in consumer spending we've seen in quite some time. So, good luck, to those sales, in the fourth quarter, or excuse me, in the first quarter of 2023, given the backdrop of falling spending in both November and December, with November revised lower. I don't think there is a third way out of this. I thought, 2 years ago or a year and a half ago or something, I said, this is it. We've seen the end of the bond bull, market. That's it. And the if you actually look at what President Biden's doing, whether you're a Democrat or Republican, it really doesn't matter here, as long as you're honest with yourself. But he's got a push here for public unions in general. Actually, that's inflationary. His the Inflation Adjustment Act, Reduction Act, is one of the biggest jokes ever. It's going to do nothing to lower inflation, but it did piss off royally the EU, who is now struggling to come up with their EU first package, because what Biden did was illegal under the World Trade organization, uh, um, funneling money for America first. So everybody can't be me first, but everyone's trying now. So USA first. China was always, of course, China first. The EU now is EU first. The EU is raising taxes. Something called CBAM. Carbon based, I forget what it stands for now, but it's a carbon border tax is what it is, which is going to raise costs, raise prices on everything going into the EU. I keep wondering where we're going to get the minerals from to build all these, electric cars, assuming we do build all the electric cars, which I kind of doubt. So, where does that money come from? What do we do about the infrastructure? Okay, so we're building windmills or whatever in offshore, or we're building solar facilities in Arizona. Okay, great. How do we get that solar energy power, assuming we build it, from Arizona to where it's needed in Chicago? You know, just up and down the line, I look at the policies of this administration. I see inflation, 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 inflation. And actually, Trump started it, to be fair, because uh, Trump's tariffs, same thing: inflation, 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 inflation. And and now we've got Social Security and Medicare, which is one of the things that you were talking about, but not in name. That spending is going to become due sooner rather than later. And of course, the Democrats want Medicare for all. My God, if that thing ever passed, good grief. So we do have a lot of these inflationary forces out there. Yep, the Fed is going to have to monetize this. There is no question about it. And yes, it's going to be inflationary. and this is going to make it hard, uh, um, uh, for the Fed to be, cutting rates. So it had for 3 decades the winds of globalization, at its back. Every time inflation ticked up, what, corporations outsource more to China or wherever. The it's in reverse now. We've gone from just in time manufacturing to bring that manufacturing home, more in the U.S. Have stockpiles of stuff in case we need it rather than just in time. All of that stuff adds corporate expense. I just don't think this is priced into the stock market, and I don't think it is priced into people who think, oh, is the first moment of weakness, Fed's going to go back to QE. So yeah, it's a real problem for the Fed and Congress, actually. I think zero is over, and Powell's actually talked about it. And if you look out on my blog, look for a post called "Effective Lower Bound," and I think effective lower bound of interest rates is about 2%, and it could be even higher in this environment. Without it being counterproductive. QE was without a doubt counterproductive. And if you look at the bubble that housing created and the aftermath of it, in now, cutting rates to 2% was counterproductive, and of course that means cutting rates to negative was extremely counterproductive. And if you look at it in that term, think about this: when the Fed cut interest rates to 0% and then started raising them, the Fed never got to the point where they were actually harming banks. The Fed was actually bailing out banks over time, and when the ECB sunk rates to negative, okay, they were hoping to spur lending. It didn't spur lending, but negative interest rates, literally a tax on banks. uh, um, the banking situation in Europe is far worse over what we've did, and now that the Fed has hiked rates. We're paying interest on reserves, which I think is a travesty. And I did a post on this about how much free money it is. The ECB is not doing the same thing. So the Fed has, by its policy, whether it wants to say so or not, it's cushioned banks here against the next downturn. So I don't think we're going to go back down there. I think the Fed would be hard pressed from an inflation standpoint, and this is where I don't know that we're going to have this financial crisis inside the U.S. because the Fed has done so much to bail out banks.
I'm agreeing. By the way, I'm agreeing with everybody. It's like I keep going back to about different time frames, right? And I'm even on Instagram. I just put this out. A lot has been made about this lumber move in the short term, and I'm still equivalently on the melt up side of things. But now you need to see some follow through in the things which are most sensitive to housing, in particular small caps, which are more consumer oriented. Anyway, more of a side note. But go ahead, Mike.
I agree with you on Japan. In fact, that's been my position actually for 5 years, maybe, that a credit event is far more likely in Japan than the United States. I have thought that for a really long time. In a way, these things are always slower to happen than what one thinks. And, people have been talking about Japan actually, and the bond bubble there dating all the way back to when I first started blogging in 2003. People were talking about Japan blowing up, but at least back then they had a positive balance of trade, with energy doing what it's doing, and Biden pushing literally pushing domestic cars here and what not, and Japan's and food prices doing what they are. Japan is in a literal world of hurt here. And I don't know what they try, but for all this, my position has been this, for all this ridiculous, and I think it's preposterous, talk of hyperinflation here in the United States. My position has always been, Japan is far, far, far more likely to experience that than the United States. Now, what could cause it here? Hyperinflation, first off, is a political event, and we are discussing politics here in regards to Japan. What does the Bank of Japan do? What does Japan do? And it's also trying to industrialize here for war. It's preparing for war to save its two islands from China taking them over. And of course, Taiwan has the same kinds of concerns. But Japan and China have feuded for a long time, and they're still skirmishing over a couple of islands out there. That's really about the energy, of course, that's in the ocean, beneath the floor bed of the ocean here. What they're really fighting over. So I don't know what they do. And I've mentioned many times in my blog, I think a credit event is coming. And someone says, well, what does that look like? And all I can say is I kind of don't know. But what's moved this along a lot is the U.S. weaponizing the dollar. This was not a smart move for the U.S. to and EU to literally confiscate Russia's reserves, impound them so they can't use their dollar reserves. The China can look ahead and say, hmm, what if the US tries that here? Right now, there's no really good way for, them to avoid, US dollar trade, and they're working on it. And I've got a post here in mind, again, talking about this brick reserve currency that right now I think is more hot air than not, but that's the path. Everyone's trying to get around. No one's figured out a way to do it. And it's going to be difficult because what do Brazil, Russia, and India and China have, together other than a desire to escape the dollar? The I don't think the politics is going to make a brick currency work, but all of these things are building. All of this pressure here is building. And a credit event. I don't know. I'm reluctant to put a time on it, but certainly some sort of massive global credit event would indeed cause the Fed to back off of these hikes.
And listen, the timing could be. I keep going back to that's why I think it's this year. The you look at a lot of loans post COVID, they mature. The new loans mature next year, and we don't even know how it looks, globally. So, if a lot of these loans post COVID mature next year, they're going to have to roll over on higher
Yes.
interest rates, right? And most crises are essentially, to Michael Howell's point of cross border capital, right? They tend to be refinancing type of
Mhm.
crises. So that's in the U.S. We don't know the global situation. It's probably not that different. So, but if that's the case, if it happens in 2024, a lot of these maturities, equities, would probably start to respond on that this year,
Uh,
right? It's not going to be that coincident. I
yeah.
would argue that they would, in that case, there would be a discounting mechanism part of it. But we can debate that.
Well, for one thing, China, which was shut down due to COVID restrictions, is now reopened. So a lot of the demand for oil, a lot of the demands for commodities, simply because China's reopened. So I think that's most of your answer there. And then a lot of times there's just these cyclical swings, and so here we have after huge drawdowns, okay, where the price of crude fell as much as it did, as fast as it did, due to Russia. Then all of a sudden, and Biden drawing down the strategic oil reserves, all of a sudden the strategic oil reserve drawdown stops, China reopens. Okay, I think that's most of it right there. I don't think so. China didn't save the global economy in 2008. The U.S. didn't do it in 2020. The U.S. ain't going to do it now. So we just have shifting imbalances, right? I think that's what's going on. And there's also probably, I'm sure, some speculative factors here. People say, "Oh, China's reopening, so oil's going to go up. So let's buy oil futures." So there's a lot of speculative demand. I think going up on these things. Some of it is just no more than technical. Okay, well, we draw a line. Same thing with Bitcoin here. Bitcoin just refused to fall below 1,500. And I almost did a post on this, and I wished I would have, because my thought was, okay, Bitcoin's about ready to make a major move here, and I think it's up. I wish I would have done that post. It was in my mind, but I didn't do it. The but there's an increase in.
By the way, real quick, most of FinTwit, in fairness, loves to draw lines. Just to your point, but sorry.
Yeah. So I think that's it. We've had a cyclical rebound here, and that's what I think it is, because I don't think this bear market is over. I don't even think it's close to being over. Another 50% decline here from here would not surprise me, at all. I've kind of had a target on the S&P of something like 2,400, which is where I thought we go at a minimum. Now I don't know what time frame we got there, because I never put a time frame on it. But ultimately, I think that's where we go, and that would just sort of make it a kind of normal, pullback in the stock market. And people, look at the stock, I think the Nasdaq was down over 32, 33%, something like that at the peak. I'm not sure what it is now. I mean, that's that's nowhere close to an even normal recession. That's how big this bubble got. And the bursting of that bubble is also going to be start to reduce demand. I think Powell is actively trying to bust the stock market as a means of controlling inflation, and it's a very, very blunt hammer. And but if I'm right, the Fed's probably going to succeed on that.
But by the way, I will say that real quick. I think you don't have to necessarily, I'd argue, go down that much in level. You can just have a decade of nothingness.
You
Right? I mean,
you
I'm
you
of the
could.
mindset, right? Like, right, and I say that because look, let's face it, we've had a lost decade plus in emerging markets. We've pretty much had now a lost decade in bonds. What's to say we're not already in a lost decade for U.S. stocks? You don't have to necessarily hit a new low. You could just go nowhere for a long
Oh
time.
my God, that would absolutely work. And in a lot of ways, now I don't. That's not my favorite scenario. But my favorite scenario was never a crash either. It was more like, okay, down 15%, up 5, down 10, up 2, down 6, up 1, down 3, down 3. Add that all up, and guess what? There was not a 20% decline in any year all of a sudden, but 6 years later you're down 50%. Okay, how did we get here? It just didn't feel like a crash. It wasn't a crash. It was just a slow grind down. you know that's always been my preferred scenario. And of course, if you want to get to Hussman's valuations, maybe the stock market goes nowhere for 12 years. But what does that do to pension plans who have actuarially counted on 6% or 8% returns every year? The whole model breaks up, even on a prolonged period of flatness.
Let's talk playbook for a moment here, right? Because just kind of allude to it. If it's a recession, it's not like anything we've ever seen. This whole environment's screwy. I mean, we can talk from here to tomorrow about what happens next to the economy, but in terms of just asset allocation, if somebody's not tactical, actively trading, um, what do you do? I mean, is it as simple as a risk parity approach, which got its ass handed to it last? What do you do as an advisor? What asset classes do you try to position in?
I mean, you don't have to be anywhere. Seriously, there's nothing wrong with being in cash, and I've said that for a long time, but I think Treasury, long dated Treasuries are a decent buy here. But if you don't want that risk, I mean, my God, on short term CDs or 3 year CDs or 2 year CDs, you can get 5% now. You know, what's wrong with 5% guarantee? These things were yielding zero not too long ago, and now all of a sudden you can get a risk-free return, not counting inflation, of 5%. What's wrong with that? I didn't read the post because I tend not to pay for any analysis, but I just happened to catch, Rosenberg, put out a piece. David Rosenberg put out a piece. And he's a pretty good economist, I think. And he said, well, it looks like we're back in a gold and treasury barbell. And I recall, and he nailed this trade, once before. And I'm sure he's not talking about junk bonds now. I don't think you would want to touch them. But the last time he put on this barbell trade, it was very spectacular, buying both junk bonds and gold. The Now I'm pretty certain he's talking about some other form of treasury. Since I didn't read the article, I don't know whether it's simply short-term treasuries or long-term treasuries, but I'm sure it's not junk in this environment. And along with gold, that's another strategy, that one can do. But if one just simply believes, that the market is overvalued here, there's nothing wrong at all with just simply raising cash and saying, what, there's a better opportunity. The problem is, I mean, this goes back to a discussion I had with someone in 2008. A fund manager, called me up and he said, Mish, he goes, I don't see anything here I like. And I said, well, I don't like anything either. He said, what's the problem? He said, well, the problem is we get paid on a percentage basis of assets under management, but we don't get paid on cash. So they have this, what would go against fiduciary responsibility here of saying, hey, we need to deploy this, cash someone's given us, because otherwise we don't make any money on it. One needs to, honestly look at that and say, you know, um, what gives here? And if what gives is you don't like what you see, then you go to the sidelines, or regardless of what that means to your own personal income if you're managing money.
I think that's a good place to wrap this space up. Everybody, thank you for joining. Please throw a follow to Mike Shedlock, Gary Brode, Eric, of course, is always a good friend and friend of the show. Again, this will be an edited podcast on all your favorite platforms under Lead Lag Live. Please do me a favor, spread the word, and please review these podcasts as I do these. Not quite out of the goodness of my heart because I'm selfishly wanting to learn myself, but just I do them for free. So thank everybody for joining. Thank you, Mike, and everybody enjoy the rest of your Friday. Thanks, everybody. Cheers.
Thanks for having me on.